What's going on, my friends? Happy Thursday. Is it a thirsty Thursday? Is it 5 o'clock yet? Trying to get a margarita, but hell. All right, I'm playing with this thing here. StreamYard continues to evolve, I'm telling you. Pretty cool. It's a cool platform, man. Or should we get Instagram Live? But as it stands, we're live on the Book of Faces. Multiple pages there. LinkedIn, YouTube, and Twitter. So let's get to this. You know, I keep getting the same question. How's the real estate market holding up? How's the real estate market doing? How's the market? Market all right? And this just comes from normal people you run into, normal people who know what you do, normal people who are thinking about, maybe buying a house, looking into it, that kind of thing. So I'm going to just get into everything today. We didn't have a great day. We'll start off with current rate update. There it is. Made the headlines. The inflation reports that we got over the last couple of weeks have not been good. In fact, you could say, let me get my thing over here. They've been bad. They've been bad. And what they've basically shown is that we're not just going to make this straight line back down to 2% on the inflation side. There's going to be bumps in the road. It's going to be some ups and downs. The data that came out today wasn't awesome. I mean, initial jobless claims a little bit less than expected, not much, pretty much in line. But productivity was lower than expected by a lot. And that had already been revised down from 3%, right? Down to 1.7. Cost of labor was a lot higher than anticipated. And that was also revised up. So here's what it was previously. 1.1 was revised up to 1.4, came in 3.2. That's the kind of thing that fuels inflation fears. And inflation is the thing that's running the whole roost here. It's running the whole roost. Everything, stocks, bonds, which influences mortgage rates, which influences real estate. It's all connected. We're going to go through all this. Let's just look at rates. There you have it. These aren't too far off. My rates are lower than these, usually by more like 0.25%. Today, it's like 1/8. And what happens is you just kind of have to realize the way that banks pursue pricing for loans. They know they're not going to deliver that loan for 4 or 6 months after it's locked, maybe longer. So they're always trying to predict what's going to happen, months away. And if the sentiment has changed and now we believe that rates are going to maybe go higher because inflation is bad. Inflation is bad, okay? It's not good for bonds. It's just not. I won't take the time to explain it, but basically it makes bonds worth less. Not worthless, but worth less. And the lower those bond prices go, the higher the rates go. So today we hit the 7% mark again on the average conventional rate. The average conventional rate. Now, Fannie Mae issued their housing forecast last week. This was done before we got the inflation bomb drops. So Fannie Mae, prior to that, was expecting, this was off a 6.7 basis, how we ended 2022 with conventional rates at 6.7 right here. They're expecting rates to drop a full percent this year, down to 5.7 by the end of the year. And it's still very possible that could be the case. Still very, very possible. We'll look at the charts in a second. It still feels very overdone. The selling feels overdone in bonds. It really, really does. But then they also went ahead and forecasted 2024 that we're going to see 5.1 at the end of 2024. So basically, we'll go down a full percent in 2023, and then we'll go down more than 0.5% in 2024. That's what the forecast is. Now, who knows if they're right or not? Also made note, percent change in home price index. They're expecting home values to go down. So somebody needs to tell Fannie Mae, how this stuff works. I mean, listen, one thing we know for sure, rates going down will cause prices to go higher. The thing that doesn't correlate is when rates go up, prices coming down. It does a little bit, but mostly what that does when rates go up is it just slows depreciation. That's really what happens. Rates going up slows things down. Because real estate is the one thing that you can sort of count on. As long as there is a growing population. That's really all you need. As long as the population is growing, real estate's going to do very, very well, as it has since the dawn of time. So, but when rates go down, that gets a lot of people back in the saddle. And so it creates more buyer demand. Speaking of, talked about this at great length, went through the Reventure Consulting graphic on the reels or the shorts if you're on YouTube. But basically, mortgage applications are down significantly. There's been very few mortgage applications. This week was pretty busy. I would say today is the first day there's kind of like crickets. Today is the first day it's kind of like, is my phone working? My phone get shut off? What's going on? Today was the first kind of day of crickets, which we're going to stocks. Stocks were weird today. The whole market was bizarre today. But mortgage demand dropped to a 28-year low. So if you go back in history and you look, okay, when was the last time we see demand at these levels? When demand for something goes away, typically that's the time to buy it, unless it's something that's fleeting, right? So if there's something that has an expiration date on it, then when demand sinks for that thing, it's not necessarily mean that you should buy it. When there is demand that sinks for something that you know people are going to buy, like housing, for example, or Apple stock, and you see demand really, really shrink on stuff like that, that's usually when you want to enter your position as an investor. You don't want to buy when everyone else wants to buy. That's called a seller's market. You want to buy when nobody wants to buy. That's called a buyer's market. Ideally, you may not get that opportunity. It may not work out that way, but that's what you should ideally want if you're a buyer, right? Because people ask me, so how's the market going? Well, it depends. Are you buying or selling? How's the real estate market? We usually measure this based on if sellers are winning or not, meaning if price is going higher. If price is going higher, then we say the market's good. It's good for sellers, right? You could even make the argument, well, it's good for buyers and sellers, because if I'm buying it today and it's going up, then tomorrow it's worth more, so I did okay. I've heard people make that argument. It's hard to argue against it. But really, when the market is hot and things are really moving and people say real estate's on fire, that really means seller's market. You're never going to hear people say the real estate market is great when it's a buyer's market. When it's a buyer's market, people are going to say real estate sucks. You're going to see, a million crash videos on YouTube. You're going to see all those things. That's a buyer's market. That's what it looks like. That's what it smells like. That's what it tastes like. That's what it feels like. And there's one thing that's sure. You've heard people say, you marry the house, you date the rate. And a lot of people don't like that for whatever reason. But the fact is, you are married to the price you pay for the house. Your purchase price, you're stuck with that. The rate, that can be changed. You can change that down the road. So yes, demand is low, but what does that actually signal? Does that mean that we're at the beginning of a crash? No. Historically speaking, this actually means the crash is over, or it's close to it, which really has just been a pullback. We're only down 4.4% from the June peak, by the way, nationwide on real estate values. So it's not like there's anything really crazy going on. You would think it was completely bananas based on, some of the stuff that's out there. All right, let's take a look at mortgage bonds here. Can I get this? By the way, we are live, so you can drop comments whether you're watching on LinkedIn, YouTube, Twitter, the Book of Faces, whatever it is. Say what's up. I would cheers you, but I haven't gotten that far yet. I will, though. So here's kind of just the ugly tape, right? This is just the ugly, just horrible looking chart that is the current mortgage bond chart. Why is this so ugly? Well, it looks like the backside of Everest. I mean, look at this. Look at this action right here. Just brrr. Now, the nice thing about this is that it looks very controlled. You don't notice how we don't see any really big sell-off days here. There's no big red candles. There's no huge capitulations taking place here. This looks very controlled. Now, the reason I bring that up is because it's typically a good sign. If there's controlled selling, that means that market makers are typically trying to bait late shorts in, meaning they're wanting people to come in and sell bonds because they see that they're down, and they're picking them up as they do that throughout this process. And then usually what you would get at the end of there is you would start to see, you get like a big green candle like this one or this one, you get, a nice big pop back up to these averages, and then you get a grind from there. You very well could see that. Today, the thing that's good about today is that we did see, even though we closed lower, so we lost 19 basis points from the previous day's close, we have a green candle here and we have a lower wick. So we got a gap down. We didn't fill the gap, but we got late buyers coming in, assessing a bargain in the market. And that is a good sign. We do want to see that. Someone told me also recently, and I want to address this right now, that interest rates don't have to go down. And it's true. It's true. Remember, in the financial markets, anything can happen. Price can always go up or it could go down. Any and everything's possible. We're just trying to figure out what's more likely, this or that. Take a look at this graph. You can argue with this, or you could try if you want. Comments are open. Federal government expenditures, interest payments. Interest payments, team. This is the amount of money in billions that the United States government is paying in interest per quarter. You want to see what this number looks like? Look at that. Q4 2022, the United States government, aka you and me, you want to know why they need 87,000 new IRS agents shaking down servers? $852.6 billion in interest. How could that be? Well, there's a few things. Number one, the government is literally borrowing money to pay the bills. When the government issues treasuries, when they sell treasuries, also known as an auction, they're taking that money and using it to fund the stuff that they're doing. Because interest rates have gone up so much, just look at where this was. You go here, back down here. Just 2020, right there. I mean, so much less. That's what, 300 billion less per quarter. Just right back there. I mean, this has gone up significantly, but particularly since COVID. Look at that. Just straight up. That's crazy. That cannot sustain. It is not possible. The numbers don't pencil. It won't work. So something's got to give. Now, my macro thesis on why interest rates will go lower in the next year or two, it has nothing to do with, even though Fannie Mae agrees with me, I could care less, honestly, what Fannie Mae says. Personally, I don't trust them. The hell do they know? Seriously. I mean, they have lots of data. They have lots of information, but they're not boots on the ground. They're backward looking, and they're making a forecast out of it. I'm boots on the ground. But my thesis is based on the idea that two things. Number one, the government cannot continue to sustain this trajectory of interest payments. It's not possible, doesn't work, doesn't pencil. Number two, Wall Street is not interested in you being able to earn interest on your money without risk. They want returns, all returns, to come through them. If you want a return on your money, you got to go see Wall Street. That's what they want. In other words, they don't want higher interest rates, because when interest rates get to be 3, 4, 5%, you start sticking your money in savings. I haven't made very many of these videos lately, so I've been doing lots of reels and shorts, but if you've been following those, you know that I've got mostly cash at the moment. Been buying Tesla, been buying Meta for a while. And those are the only things I'm accumulating, been mostly in cash. I just looked at a bank statement yesterday, couldn't believe how much interest we're getting paid. Wall Street hates that. They hate that. They want you to have to invest. So you've got Wall Street, which is a huge, huge contributor to policy. They have a huge connection with government and the people who run it. they're a massive influence, and they want lower rates, because when rates were at zero, everyone was trading stocks. Remember when the interest rates were super low, everyone was a day trader, everyone was talking stock tips, Wall Street bets, all that stuff. Wall Street wants that. That's what they want. So if that's what they want, the government is going to need this to get better. That's the reason why I believe rates are going to go lower, and I've placed some big bets on that. See how it goes. I could be wrong. Never know. Let's see what we got here. Thanks, Brian. Appreciate it. Just making sure the comments work. Just appreciate the fact that you chimed in. Want to say hi? Say what's up? Please do so. All right. Let's see. Where are we at here? All right. Looked at stocks today. Oh, this is what they said today. Fed officials' comments gave the markets confidence to rally. I don't buy it. Too convenient. What he was talking about. So Bostic said, "Hey, let's see exactly what he said today. That he was, okay with, or he was, right now, I'm still very firmly in the quarter point move pacing. He wants slow and steady. In other words, he doesn't want to raise rates a bunch. That's what this fear is about. So the fear in the financial markets is about inflation, and the Fed, because inflation seems to be getting worse, or was at least worse in the most recent reports, that they will hike more and be more aggressive with that. That is, of course, not good for stocks. And so him saying, "Oh no, I'm down with a quarter point," that isn't what did it. That isn't what did it. Let's take a look. We're gonna look at a few things here. If there's any questions, feel free to type them in the chat and I will address. Otherwise, I'm just going to show you what I'm thinking, what I'm looking at, what I'm seeing, what's going on here. And, remember, anything can happen in the financial markets. I could be wrong about all of this stuff, but I'll give you my 2 cents too. So here we had this nice channel in the S&P. This is the S&P 500, right? Nice channel. You want to see, this hold ideally. And we broke it. It got broken to the downside here in the last few days. These are daily candles. So let me make these bigger. So it broke, right? And that happens. Sometimes it's a fake out. You get a little break like this. It's a bear trap. Get a bunch of people short in here, expecting this thing to go lower, and then just bring it right back in there and send it. That could happen. Okay, that could happen. This was right at a 382, I believe, as well on the fib. I just got to be close to it. Yeah, look at that. Pretty much right on that 382 retracement. We got the pop. Now, some people will call this a short entry right here, because you're coming back and you're retesting that trend line from the other side. So there's a lot of people who would tell you that this is likely to sell off tomorrow. We'll find out. We'll find out. It did come up and touch and peeled back a little bit towards the end. But if you break this down on like a 5-minute perspective, we zoom in a little bit, you can see the market gap down, kind of went up. It looked like, well, we're not even going to, close the gap here. And then boom, just went bananas. And they're saying it's because of what Bostic said, but I think that's a convenient excuse. Okay, the market does tend to make big moves around 10:30 a.m. Pacific. Look at the time of this move, 10:35. I think they just use that as an excuse. But it's, it did make a big move higher. There was no news. There was nothing happening at the time. So I don't know if that means necessarily, that this is going to continue. But as you saw on the daily chart, and this is what I want to stick with, I want to see how this reacts. I want to see if this can push, if this can get broken back into. If so, this was a fake out to the downside, and we can see a lot more upside for stocks. I don't think that's what's going to happen, but it could be. Let's see here. What are rates? Okay. This is mortgage rates today. Like I said, my rates are about 1/8% less than these. Usually I'm more like 1/4% under this, but that's what it is today. So like VA rates, 6.375. Actually, conforming balance, I did quote a conforming balance VA rate today, 6.25, and that was later in the day. So yeah, 6.25, 6.375 for FHA and VA, more like high 6s for conventionals. But yeah, this is where rates are at. This is actually pretty. I know I'm kind of in the way. So there we go. This is basically where we're at. So market not helping us in this realm. Thanks for participating, Brian. Appreciate it. Drop your comments, questions if you have them. But that's basically what I see is going on with the S&P. Okay, so we got a little bounce off the 382 this particular cycle run. Let's see what happens. If we can break back in there, then okay, hey, we can get bullish again. Right now, I'm still bearish on stocks. Until that changes, I'm bearish on that. One thing that is interesting, let's look at Bitcoin. Look at this one. And we'll look at Tesla. We'll look at Meta. Look at this. Look at this channel. So perfect. Oh, and if you think crypto's wild, it's actually amazing how technical Bitcoin is. So here's a perfect channel. And you can see how much in the middle trend line here, it's dotted. So basically you build the trend off of this right here, boom, bring it up. And that's the middle line. Look at how closely tucked in it has been a couple times here. So the first time we reached this major resistance, this white horizontal line right here, we knew there was going to be a big sell-off. Had to be. Just had to be. There was too much right here. Had to sell off. And it did. Got a big rejection. Came all the way down, made new lows. Then now the second time we've come up here and touched this, not quite the same rejection. At least not right away. Seems to be a lot of support here closer. So this actually looks like it's winding up a little bit. And I think we could see Bitcoin make a run and go and touch the top of this channel. I have this area marked up here, about 31,300. I see that as being an area that we should expect to see some action at some point. So Bitcoin actually holding up pretty well right here, even though we're on the underside, on the bottom side of this channel, it's holding up pretty well. Seems to be sticky, seems to be light. And so that's a good sign, I would say, for Bitcoiners. Dollar index. This has been driving a lot of things. Remember, the dollar index, when inflation is present, this should do poorly. But notice how it's been the opposite. Like, how do you reconcile that? So we get bad inflation reports and then it runs higher? Huh? What? Are we in the upside down? What's going on? I couldn't tell you, but we're back at this major resistance level, which we got big rejection on the first time we truly retested it. We got big rejection from it. We'll see if we get big rejection again, or if this old trend line right here holds up. Which it very well may. That may hold up, and we may see the dollar index go higher. Why does that matter? The dollar index goes higher, then you're going to see stocks and stuff go lower. So try to follow both of those things. So right now, we have both at resistance. It's very unlikely they both go lower. So something's going to give. Which one looks stronger to me? Man, I personally wouldn't want to short this dollar because they're so close to these lows. I don't like to short lows. And with the S&P, it's not that you're not towards the lows, but there's a lot more room to me to the downside here. So that's why I'm just not feeling stocks at the moment. I hope I'm wrong. Bought some more Tesla today. Just picking up bits and pieces. Got all the lines drawn here on this one. This is a daily chart, remember? And what happened today was, so they had an investor day yesterday, Tesla did, and the reviews are pretty weak. Yeah, the reviews are weak. So people didn't love it. And although it was good from an analyst standpoint, a lot of the analysts were like cool with it, but investors didn't like it. So we got a big gap down today, and we gapped down below what should have been support. So I would say that's no bueno. But I was able to buy some earlier this morning, got a pretty good price on it. And I will continue to dollar cost average into more Tesla until I have the amount that I want of it, which I don't yet. But this is just kind of a situation where, actually, let's pull the fibs on this and see what we can expect here. I know a lot of people are invested in Tesla with me here. Okay, yeah, so we gapped down below that 236 and then got some resistance at the 236. It's entirely possible that, we could see Tesla come down to, 173, 175, or even 165 or something like that in the coming days. But I would say if it does, it's definitely a buying opportunity, and I will definitely be in there buying. Anytime it's going to have like a big red day like this, you can just count me in. I'm in for 10 shares at least. And I'm just going to continue to accumulate, hopefully get some better prices on this thing as time goes on. So yeah, so not a great look for Tesla at the moment, Not a great look, but it's one of these things. It's personally for me, like I'm not even considering selling it. I wouldn't consider selling it. That is something that I plan. I hopefully will hand my Tesla shares over to my children who are very young one day. Meta. This one's really interesting because we had the gap up from this channel, right? So the huge gap up off of earnings. Most recent earnings came in after the bell. Really wasn't that great, but it was better than the market expected. And since then, just been sort of peeling back. Look where it landed. It landed right here and is sticking to the top side of this trend line, which is really interesting because we only got one touch on the top side of this trend line. Normally, you get one touch, two touch, three touches. You need three touches to make the trend line. And the fourth touch is the best one, the one you can count on the most. And we never got that on the underside. We got it on the top side. And now it's kind of holding as support. So really interesting structure for Meta, which has been all over the place. And look at these gaps. This is just so bizarre. This stock is so bizarre. But there is support down here. If this does fall down into the 150s or in this area right here, then I will be buying more of that. As of right now, with where my cost basis is, I'm hanging tight, waiting for better prices. If I don't get them, then okay. But I will continue to dollar cost average into this one. But I just need a little bit lower price based on where my current cost average is. Just my strategy on that one. I want to see lower price. But buying Meta, buying Tesla, I believe those are both long-term plays that are going to work out really, really well. Okay, question about ARMS. Comments are still open if you have them. ARMS still not really worth it. Almost nobody is getting ARMS. They're not more lenient as far as terms are concerned. With ARMS, you basically have to qualify for them just like everything else. But when rates are sort of like this, when the future of bond prices and interest rates is really uncertain, ARMS tend to not make sense. Right now, they just don't make sense. Like for the most part, you can get a fixed rate that's better. Although some days I've priced it and it's been like a full % lower for certain people to get an ARM. So we always check. We always check and pull the rates live and check because you never know. That's one of the nice things about being a broker. I run a pricing engine. And when I run my pricing engine, I get all these results. See, this was me. I pulled a jumbo $1.36 million VA quote earlier, 6.375 right there. But I get all these results. So I've got dozens and dozens of banks that are fighting for this business. Oh, wait a minute. You guys can't see that. It's over here. Wrong screen. My bad. So when I pull this, it's I'm looking at all these different banks, right? Oh, we got to refresh them. Let's see what's changed. Let's see if it's changed from 6.375 since like an hour ago. Nope, same. So, I'm looking at this and going, okay, who's got the best deal? Well, right here on this particular loan is United Wholesale, which is great because they're a great bank. 6.375. And that's for V8. Now let's take this down a notch. Let's just do 700,000 real quick. Let's see where this is. I believe this is going to be at 6.25. See fees in here, so no lender fees. Yeah, 6.25. And look, now United Wholesale is not the best priced. Now they still have the same price at 6.25, but not as big of a credit. This one we could go to CMG, Penny Mac, or JMac and get a much bigger credit for the client. So for example, CMG at 6.25, they're paying you $2,700. Or you could spend 196 or do a 21-day lock if you're doing a 21-day escrow, and you can actually get 6.125. This is why being a broker is just so advantageous. I don't work for the bank. I represent clients with the bank. So I can help you figure out how are we going to get the best deal. This is just how it works. So that's why it's important. And that's the reason I want to be a broker. Because for example, if I was just a loan officer at United Wholesale, I would still have the 6.25, but I wouldn't be able to give you that 2,700, right? I still got the 6.25, same par rate. And actually the 6.125 is only $455. I don't have a 21-day lock option here, but if I can go to 15 days, you get pretty close to that. So not too far away. Not too far away in this case. But for just a straight 30-day lock, the CMG pricing gets you an extra $2,400. So, that's a big deal. That's a big deal, and it's free money to the buyer. So good question, Brian, about the credits. So it's not that they offer the credits, it's just the way that pricing works. So when you pull a rate, now at the banks, sometimes they just scoop this, right? Like they just put it in their pocket. But as a broker, I'm getting compensated a certain flat amount, and that amount is what I'm getting regardless. And so whatever's left over goes to you. That's just how it works. So you see how it's not linear. There's nothing linear about these matrix. And the pricing itself, let me make it a little bit bigger, easier to see. And the pricing itself, this is how it works. You have costs here in red. So these are all in red. These are costs. In green is credits. So for example, we just had a client who wanted to change his rate so he could get some credits toward closing costs. We moved the rate up a little bit for him, and he got a few $1,000 to cover the rest of his closing costs beyond his EMD. VA buyer. So that's the way that you can do it. Now, if you also want to get a lower rate, you can go and you can buy it down with this red. I highly recommend, to make this very clear, I do not recommend buying the rate down right now. Just wouldn't do it if I were you. I think it's a waste of money. I do believe, because I believe that rates are going to go down. And I explained why earlier. There's huge macro forces that are going to be working to get rates lower. And they're in the process of trying to make rates lower. There's just, it's tough with ugly inflation reports. You get mixed messages. You have different people in the markets wanting to take different sides of the trade. You want to get everybody on the same side. That's how we're going to get good movement on that. In order to do that, we got to get good inflation numbers. We just haven't had them. We had them for a little while. Rates started going the right direction, and then bad inflation numbers came. Now we're back in this boat again. But in all reality, the 6.25 isn't bad. It brings up the 2-1 buy down again. The 2-1 buy down becomes a big deal. So, all right. Did I have anything else here? Housing forecast. I'll put that link in there. Government interest payments, $852.6 billion per quarter. I put that in there. I'll put this in there. I'll put that in there. This one too. Yep. I think that's it. We got them covered. All right. Let's see. Have any new comments or questions here? 2-1 buy downs. Yeah. Opinion on that. So 2-1 buy downs. If you can get the seller to pay for your 2-1 buy down, it is for sure the best thing out there. It's the best thing since sliced bread because you can't lose money on it. If you do a traditional buy down, remember we were looking at the rates over here. So like, let's say you did this. Let's say you're over here. Let's use this rate sheet. Instead of taking this 6.25 or really 6 1/8, right? We turned the lock to 21 days. They're almost all 21 day escrows. Now we're at 6 1/8. And that actually has a small credit to it. Pretty cool. But let's say you're like, you know what? I'm getting a credit from the seller for $10,000. So I'm going to go ahead, or no, let's make it more closer to 2%, which is where the buy down would be. So I'm getting more like $14,000. This was a $700,000 VA purchase that we're doing here. So I'm getting $14,000. So I'm going to buy my rate down to 5.5. Okay. From this 6 1/8. It's going to cost $13,307. But my payment's going to go from $4,253 to $39.75. Watch this. The one thing in the one subject in school everyone can really use in life. Calculator. Math. Okay, so 4,253 minus 39.75. So this is how much you're going to save per month. $278. So you're going to pay 13,307 divided by 278. So your $13,000, it's going to take you 4 years, or 47.8 months. It's going to take you 4 years to break even on that. That's just to break even. So you need to have this loan for well beyond 4 years before you're able to actually make anything out of your investment in this lower rate. I promise you this, unless you lose your ability to qualify for a loan, you're going to refinance within the next 4 years. That I can all but guarantee you. So you're going to lose money on that. Now with the 2-1 buy down, I see your question, Brian. With the 2-1 buy down, when you refi, whatever is left, whatever is unused from the buy down subsidy that was provided by the seller gets credited towards your payoff. It gets credited towards the amount that you owe. So you can't lose. With the traditional buy down, you absolutely can lose. In fact, most people do. And that's the reason why they offer it. They offer it because they know some people will get stuck on numbers. Hey, I want 5.5%. I don't care what it costs. I have the money. I don't give a shit. I want 5.5%.
Yeah.
All right. Well, you can have it, but it's going to cost you 14 or 13.3. Okay. And if you want to set your own money on fire, by all means, it's yours. But I wouldn't if I was you. That's all I'm saying. So the 2-1 buy down is the thing again. And this is something that I think more people are aware of now, which is good. So for buyers who are going, hey, I get it. I get it that this is good. I get it that the market sort of slowing down a little bit, mortgage applications demand being down a little bit. Okay, I get it. That is good for me. But also, I want to not pay an arm and a leg per month. 2-1 buy down. 2-1 buy down is the way to go. Look, I get it. I get it. It's hard. It's hard to pull the trigger when it's the right time to pull the trigger. It's hard. It really is. But if you're ready to do it, if you're ready to look into it, give me a call, shoot me a text, send me an email. Let's get you pre-qualified. Whether you want to buy or refi, you'll work with me directly. Not going to get handed off. I will hook you up like a tow truck. Have a good night, my friends. I got a margarita with my name on it. Take care.